In this video, I'm going to talk about how to account for an exchange of non-monetary assets when the transaction lacks commercial substance or when you can't determine the fair value of the non-monetary assets. So if you remember from previous videos, our general rule of thumb was that we're going to record the asset received at fair market value and then book a gain or a loss. But if we don't know what the fair market value is, then obviously we can't use the fair market value to do this. And so we're going to do an alternative method where we're actually going to bring the new asset in at the book value of the old asset, adjusting for any cash. So also we do the same method if there's no commercial substance to the transaction. And commercial substances is kind of a tricky issue. The main idea is that by doing this transaction, there should be some change in the underlying cash flows for the firm. So if the firm decides to trade one truck for a truck from another company, it's assumed that, okay, if there's some commercial substances, that if this is a real transaction, then the cash flows of the companies should change, right? There should be some value, some economic substance to this deal. And the idea is that we don't want the firm engaging in some kind of sham transaction where they say, yeah, we got this great new truck and we're going to book a gain on this, when in reality they just gave up one truck for a similar truck, right? So the FASB wants to avoid these kind of sham gains, and so they say, look, if there's no real change in cash flows or commercial substances transaction, then you can't book a gain or a loss. And we'll talk about this third criteria, the exchange being made to facilitate sales to customers, in a different video. But right now we'll talk about these two. And if you want to look up the specifics of the no commercial substance criteria, if you can't sleep tonight and you just really want to read some exciting accounting stuff, here is the citation for you in the ASC code. So let's get into an example. So let's say that Thompson Trucking gives a delivery truck to Tito's Transportation. And in exchange, Tito's Transportation is going to give a dump truck to Thompson, right? So we've got a delivery truck being exchanged for a dump truck. And so from Thompson's perspective, the original cost of that truck that they're giving away was $22,000 at $18,000 in accumulated depreciation. Now, conversely, Tito's, their original cost of that dump truck was $67,000, accumulated depreciation of $58,000. So let's go ahead and we're going to do the journal entries, and it's going to be a little bit simpler than when we did it with the fair market value. So Thompson is giving up a delivery truck. So they're going to credit the delivery truck for the original cost of $22,000 to zero that out. Then they also have to debit the accumulated depreciation that was attached to that delivery truck of $18,000, right? Now we've got a plug here. So we've got a plug, and that plug, that's going to be $4,000. So it's going to be $4,000 just to make our debits and credits balance, right? So we have $22,000 here, $22,000 here. And if you think about it, they're basically saying that the book value of the asset they're giving up, which was $22,000 minus the depreciation of $18,000 for $4,000, that's going to now be the value of the new asset, the dump truck that they're receiving, right? So because of that, there is no gain or loss, right? Now, from Tito's perspective, Tito is getting rid of the dump truck, which originally cost $67,000. So we credit dump truck for $67,000, and then we debit accumulated depreciation for the $58,000, the depreciation that had been taken on the dump truck up till now. Then Tito is going to debit the delivery truck that it's receiving. How much is it going to debit it for? Well, we've got a plug here again. So all we do is to say, okay, that's going to be $9,000. How did I get that? I just said, well, we take the $67,000 in credits and subtract the $58,000 in debits before the plug, and then that tells us we must have a debit of $9,000 to make this entry balance. Okay, so now you'll notice that in each case, for each firm, there is no gain or loss, so this is not going to affect the income statement. So if we couldn't figure out what the fair market value was of any of these assets, well, then it doesn't matter because we're now just basically using the book value to assign a new value to the asset received. And if there's no commercial substance here, then the company can't recognize a sham gain or loss.